You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, we are taping Options Playbook Radio on Wednesday, March 23rd. The markets are closed right now, and we had a very befuddling day in the marketplace. And I say befuddling because we looked at a long VIX spread using call options last week and just kind of talked about the fact that the uncertainty or the fear index in the VIX just keeps drifting lower, even though the geopolitical concerns grow, inflation grows, 10-year interest rates set a new high today. All of that being said, we saw the S&P 500 index was down around 1.3%. And then we see the VIX up about 2.3%. It's trading right around 2350. So that's a fairly big down move in the S&P 500 index. And to see the VIX with all of these fear factors in the marketplace just kind of creep a little bit higher and yet still stay below the 24% level is a little, like I said, befuddling to me. But let's add in the fact that GameStop has been on a roll. It's back in the news again. Today, that finished up a mere 14.5% on the marketplace. So why not? With that said, I actually sent out a tweet today, and I wanted to make sure the rest of the United States actually knew that Russia did invade Ukraine, that it happened, and that we have a very inflationary environment. Now, I'm not saying that the market should go higher or lower based off of that. My thought is just that I don't know why people are so comfortable with the marketplace and they're not willing to go out and pay up for insurance products like the S&P 500 index puts. And that's ultimately what drives the VIX index is people buying puts to try to hedge portfolios. But it just does not seem like a lot of people are concerned about that marketplace. So let's start by reviewing the trade that we looked at last week. There's not too much to review. I was looking at this and I saw this move today. I would consider getting out of it. As always on Options Playbook Radio, and I definitely need to emphasize this, especially when talking about VIX options. Nothing is meant to be a recommendation. The VIX is a different beast, and we talked about that on last week's show. There's a lot of nuances to trading options that trade under the ticker symbol VIX. But we looked at a long call spread. The strike that we bought was the 27 strike. The strike that we sold was the 29 strike, going out to March 30th expiration. So we still have some time. There's still a lot that could happen for now and then. Because the way the skew is in the VIX options, it was a relatively inexpensive long call spread, considering that the futures contract for that March 30th expiration was right around the 27 strike. So we paid 57 cents for a 2-point wide spread. And I went and got a quote on it as of today with the markets closed, which is March 23rd, Wednesday. We see that long spread is trading for 30 cents. And that doesn't surprise me. The market is down on the VIX index, down to around 23.5. The future's a little bit higher than that. And so you've lost about half your value. So a lot of times and a lot of rules as far as long call spread traders are concerned, they say, well, if I'm down 50% of what I paid for it, I'd get out of the market. So in that concept, this is a general concept of investing in options. Some people will say, well, on the downside, if I am down on the trade, I'm going to privilege what I can. On the upside, I'm trying to let it ride. So in this instance, I could have made a $1.43 on the upside. On the downside, I had 57 cents worth of risk. I've lost half of it, so I get out of the trade. It's just a simple rule. If you want to sometimes trade, you don't always get the luxury because it moves so fast and so quick. So I'd consider just closing it out, especially when we have a down move in the S&P 500 index, and we see the VIX only jumping up 2.3% today on that down move. And actually, that's finished fairly close to its lows, I think. I'm not 100% sure. I'd have to look at the chart. But so it's at the lows today. We got the VIX just trickling upward. And it's just kind of a head scratcher to me. But GameStop is up 14%. And it was up 14% yesterday, I think I recall. So why not? Why not? What the heck? All right. So today, we're going to stick with the theme. I haven't talked a lot about the stock splits, two big ones that are coming on the mega cap side. We have Google that is going to be that's going to be splitting 20 for 1. And that is going to happen around July 15th. Right now, I think that's the date that they're going to be trading after the split. We'll also see one in Amazon. And I'm going to focus on Amazon today because it is the closest split at this point in time. So in Amazon, we're looking at somewhere about the first week in June that they're going to be trading after the split shares, after everybody receives all their shares from 20 for 1 split in Amazon. So we're going to actually use that June expiration. So we're going to target an expiration that expires after the June expiration. And this is literally just going to be a 50-50 trade in Amazon. We're just going to try to take the momentum of the stock split after the announcement has waned, and both Amazon and Google recently, after their splits, actually came off a little bit. Now today, Amazon, we're seeing it trading at 3,268. It was down 29 points on the day. And we saw a similar type move to the downside in Google today. So maybe we can take this as an opportunity. If you do believe that going into the split that Amazon could do well with that in the background, then I want to use a long call spread to manage my risk on that trade. And then also I want to be aware of the time premium, because there's going to be a lot of time premium in your option contracts. You're going to end up, for every option contract that you own, you're going to end up with 20 of them when it is all said and done, which is interesting. Obviously, it's going to be a much lower strike price. So there are some concerns with that. And I usually write a blog a little bit closer to the event that will highlight some of these concerns. But if you go to theocc.com, that's the Options Clearing Corporation, there is a PDF that puts out exactly the terms and conditions of the contracts after the split. And I always want to be aware, if you are buying options pre-split, you want to know what your strike price is going to turn into, because you are going to have a different strike price on your option contract. If you're dividing that strike price by 20, that usually means that you want strikes because it's an even number. And when it's divided by 20, you're going to end up with an even number, not a fraction share. So with that mentioned, I am going to pick just nice round numbers on strikes for this Amazon trade today, because after the split, I want to have an option contract that doesn't have some weird ratio in it. And when that happens, sometimes the volumes will dry up a little bit. Some of the open interest will go away. Markets get a little wide. And in Amazon and Google, I don't know if that's necessarily going to be the case, but why not just avoid it? If it was a lesser known name, you definitely see volumes dry up on the weird strikes, on the odd strikes. All people gravitate towards the strikes easy to understand, and those are the option contracts that usually have the best markets in them. So we're going to look at the June expiration. So that's going to be the middle of June. That's the standard month. And we're going to surround where the underlying stock closed at today. And our goal here is to not really mess with time premium. We're going to limit our risk. We're going to have limited and known downside risk and limited and known upside risk. But we're not going to pay a ton as far as time premium is concerned, because that's not our goal. We just want to move based off of the strike. So in order to accomplish that, you a little bit in and you sell a little bit out of the money, and that will get your break even fairly close to where the underlying stock is at. So we have the June 17th expiration, sticking with our rule. These are expensive option contracts. We're going to look at buying a little bit in the money. So I'll highlight that Amazon closed at $32.68. We're going to buy the $32.40 strike call outright. You're looking at that call at the midpoint is trading for $228. Multiply that by 100, and that means the cost to buy one option contract is $22,800. Now, after the split, you're going to have 20 contracts, but with that said, that's a very expensive option contract. That's quite a bit if you're thinking about just buying one option. So we're going to spread that off, and we'll look at selling the $32.80 strike call option. That's trading around 207. If I look at my Ally Invest quote for the whole spread, the one-by-one spread, we see a midpoint at $20.88 will $21. So that's a much more acceptable price. You have $2,100 worth of risk if you put this trade on. So I'd rather do this before the split. I want to be aware of this. I want to do this leading into the split. And we're just we're hoping that we get some momentum that was lost after the announcement of these stocks, but hopefully it will build going into the split. Now, splits have nothing to do with the stock price. It's been said time and time again that the fundamentals of the company don't change. A split just makes it a little bit easier for somebody to buy a nice round lump of 100 shares of these underlying stocks, as opposed to a $1,268 stock we're looking at around like $160, $170 stock when it's all said and done, depending on where the stock is at when we do the trade. Or when the split happens. All right. So let's go through what we talked about and try to bring it all into the fold. We are looking to do Amazon, and we're doing Amazon mainly because of the split. So a highly speculative trade. The option contracts are ridiculous. Looking at the June expiration, we're targeting the June 17th expiration. Because of that, we're going to do a long call spread. We're going to be very careful with our strikes because after the split, we want to have a nice even number on our strike prices because they're going to be divided by 20. So we are buying the June 17th 3240 call, selling the June 17th 3280 call. That's a 40-point wide spread. We're looking to pay $21 with the markets closed. That's the midpoint on the spread. Never a guarantee. We obviously have to add commissions in here. That means our total risk on the trade will be $2,100. And that will be the paper trade for this week. Now, if I am thinking about this trade and I'm thinking about time premium, I don't know where even is at. So how do we figure out the break even? The break even will give you a hint as to how much time premium you're actually paying. Another way to do it is to just actually calculate the time premium on each option contract. Okay, so to give you some hint as to if you're buying or selling time premium or receiving time premium or managing time premium, one thing you want to look at is where's the break even at on the long spread. And to figure out the break even, you take the strike price of the call option that you are buying, which is the 3240 strike. And if you can fill at that midpoint of about $21, you add that to that strike and you come up with 3261. That is the break even point for this long call spread. Guess what? Amazon's trading at 3268. That means the stock can actually go down 7 points in order for you to break even on this trade. So, interesting trade, 40 points wide. We're paying $21, and the maximum that we can make on this trade is 40. So 40 minus 21 is $19. It's basically a 50-50 trade. And if Amazon just stays where it's at, we're going to do okay on it. But ideally, we would like it to get up to the 3280 level. So an interesting play. You're still risking, I think, on options playbook radio, we talk about trades that are not where you're not putting up quite as much capital on a one-by-one basis. $2,100 is nothing to sneeze at, but for every one-by-one trade, we definitely have reduced the risk as opposed to buying the option outright. So that would be our goal on this trade. And we're going to have a lot of time for this to play out. We'll probably come back closer to the Google event, and we will look at doing the same type of trade on Google. Why not? They're just paper trades. This is how we would speculate on these stock splits. And that's what Options Playbook Radio is all about. We're just trying to take some of the 40 plays inside the Options Playbook and look at scenarios where they might apply to a specific situation in the marketplace. So in this instance, if I wanted to speculate these type of moves, I would be looking at a long call spread because of the sheer cost of the option contracts. That's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show, please email me at theoptionsguy@invest.ally.com. You can always follow me on Twitter. I tweet about all of the educational events that we do through the Ally Invest platform. And that handle is very simple. It's at my name, at Brian Overby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.